Wait, what if I told you there's a loan that lets you finance not one, not two, but 4 properties with a single down payment? You're probably thinking that sounds too good to be true. But here's the twist. It's been sitting right under your nose this whole time, and most investors have no idea it even exists. The secret weapon is called a blanket loan, and it's basically the Swiss Army knife of real estate financing. Instead of drowning in paperwork for 4 separate mortgages, you bundle everything together, one application, one closing, one down payment that covers the whole portfolio. Think of it like buying groceries in bulk at Costco instead of making 4 trips to the corner store. You're leveraging economies of scale, slashing closing costs, and saving yourself from the nightmare of juggling multiple lenders who all want different documents at different times. Here's where it gets interesting. Back when interest rates were at rock bottom, everyone was rushing into single-family rentals like it was a gold rush. Now that rates have tripled and everyone's spooked, the opportunistic investors are the ones quietly stacking properties while others sit paralyzed on the sideline. The psychology is fascinating. When markets are hot, people overbid and overpay, convinced they'll miss out forever. When uncertainty creeps in, suddenly that same property looks terrifying, even though the fundamentals might be stronger than ever. We've seen this movie before. 2008 crashed, everyone swore they'd never touch real estate again. Then by 2013, the same people were kicking themselves for not buying. 2020 brought pandemic panic, yet those who bought during the chaos are sitting on massive equity just 4 years later. The blanket loan pattern is predictable too. It thrives during expansion phases when investors are building portfolios aggressively. When credit tightens or sentiment shifts, lenders get cautious, terms get stricter, and suddenly that streamlined financing option becomes harder to access. Here's the misconception that trips everyone up. People think blanket loans are only for mega developers or institutional players with deep pockets. Truth is, plenty of regional banks and credit unions offer them to everyday investors who are buying just 3 or 4 rental properties. Another fear? That cross-collateralization, where all properties secure the entire loan, means if one property struggles, you lose everything. Reality check. You're managing risk through diversification, and one underperforming property is offset by 3 others generating cash flow. The historical lesson is simple. The best deals happen when everyone else is scared, and the tools that accelerate wealth building are most accessible when demand is low. If you're sitting on capital right now, this is your window to act. While competition is thin and motivated sellers are negotiating, don't confuse conviction with strategy. Conviction makes you emotional, strategy keeps you disciplined. Your edge isn't predicting the future. It's controlling position size, maintaining liquidity, and executing a repeatable process regardless of market noise. The smartest investors I know don't care if they're buying at the absolute bottom or if rates drop another point next year. They care about cash flow coverage, conservative underwriting, and building a portfolio that survives any economic season. Blanket loans amplify this advantage. Lower transaction costs mean your returns improve immediately, and consolidating debt simplifies management so you're not buried under administrative chaos. You're essentially hacking the inefficiency out of traditional financing. But let's be real, this isn't a magic bullet, and it won't save you from buying terrible properties in terrible locations. Due diligence still matters. Cash reserves still matter. And if you're stretched thin financially, bundling risk probably isn't your smartest move. The philosophical truth? Markets reward patience, punish panic, and couldn't care less about your feelings. Whether rates are 3% or 7%, whether sentiment is euphoric or depressed, the fundamentals of buying income-producing assets below replacement cost remain unchanged. I'm comfortable either way. If the market rallies, great. My portfolio appreciates. If it stalls or dips, even better. I'll keep acquiring at discounts while others wait for perfect conditions that never arrive. If you're ready to explore real estate investing and find properties that actually pencil out, check out www.growthsense.com, where investors can find investment properties and sellers can list investment properties. It's a straightforward directory connecting buyers and sellers. Nothing fancy, just properties waiting for your analysis.